Hi, and welcome to the quarterly update. And actually, we're looking at the year-end update. My name is Troy Moliat. I am the owner of Landmark Real Estate Management, and with me today is Kim Heisinger, our Director of Property Management. Kim, hello.
Hello.
How we doing?
Doing great.
End of the year, start of a new year, and things are definitely busy at Landmark, correct?
Very busy always.
Awesome. So, what we're going to do today, for those of you that are joining us, our clients, again, thank you very much for being a part of Landmark. We today we're going to just review the national multifamily market. We're also going to look at the local market and give you some more specifics on that. And then we're going to talk about factors impacting the market moving forward. And real estate markets are shifting, and we are here to provide you with a bunch of information to kind of show you how that market will impact you as a property and a landlord owner. Once again, we just want to thank you for being a client of Landmark. And we are just so excited for those of you that are clients joining us today. Thank you so much for being a part of Landmark. We're going to talk a little bit about our core purpose, and Kim's going to talk to you more about kind of what we do at Landmark and what we're all about. So, Kim, take it away.
Awesome. Well, we'll start off with what is Landmark's core purpose, and that is opening doors and building wealth. So that's what we essentially do here, property management, but we do that through opening doors and building wealth for our clients. Next, we're going to get into what are our three uniques as a company, and our three uniques are we are trusted, structured, and investor focused. We've also created some core values as a company, and these are things that we look for in our partnerships with our clients, and as well as values that we look in that we hire our team members from, and just what we as a company value. So those are does what's right. We do that every time with integrity for you and your property. We maintain accountability, and we take full responsibility for all aspects of management. We are problem solvers. You enjoy property ownership, we handle the problems. We drive change, so we set the industry standards, and we serve others first. So client and tenants' needs come before ours. So those are our core values. And then we have a proven process as well for what we essentially do. So we start by optimizing, we move into management, we deliver and grow. So starting with optimize, we analyze your property, make suggestions for improvements, come up with plans. Then we move into the management model, which we'll talk about in just a second in a little bit more detail. That's essentially our core functions of what we do in our office. We deliver, so we move into results and solutions, and then growth, so helping with new opportunities and long-term wealth for our clients. So now I want to talk a little bit more about phase two, which is the management model. So we have basically a 7-step process. So this is extremely simplified. But what we do is we market the properties, we qualify the tenants, we onboard the tenants, we collect rent, we maintain the properties. So any work orders that come in, we're solving, managing. We're always communicating with our tenants and our clients. And then we transition and get ready to begin the cycle again. So that's essentially what we do here in a really quick snapshot.
That's awesome, Kim. And there's so much more in each one of those 7 different wheels of the management model that happen on a daily basis through the accounting team, through our pods, through our showing agents. There's just so many different aspects of management that people don't see. And you lead that team, and thank you for all that you do.
Thanks so much.
So Kim will join us later, but now we're going to hop into our executive summary and we're going to talk more about the national market. And so let's hop into that. And so once again, today we are going to do the following. And if you can't join us for the whole webinar, this is a great little executive summary for you. So we're gonna talk about the national market, but I think 2026 is the time to buy. And I've been saying this really for the last couple of quarters, but I think 2026 is the time to buy. with bonus depreciation now in full effect for real estate, it's just a great opportunity for investors to buy, be able to accelerate that depreciation, be able to offset other income, and really enjoy, I think, a market that is softened and gearing up to be able to grow. New construction has really been falling in the nation. It peaked back in 2023 and it's been falling almost every quarter since. And so we overbuilt. That COVID money of 2021, 2022 really has worked itself into the system, and a lot of people built units. And we've seen heavy vacancy in most markets in the US, and that is now starting to peak and soften. And construction has fallen way off, mainly due to construction costs and also just an oversupply of the market. Vacancy rates are really at 10-year highs and they're peaking right now. We've got some new adjustments on where the vacancy rate is and on the nation, and I'll show you that in a minute. Existing rents are really flat to really slightly increasing. I would say they're pretty stable right now. Depending on the market that you're in, you're seeing some concessions. But again, existing rents for the most part in the US are flat. Sales are stabilizing. When we look at quarter four of 2025 versus quarter four of 2024, they are up slightly, overall sales. So we're seeing some more money come into the market. A lot of that's interest rate driven. And then finally, interest rates, really there's some pressure to go lower. I will talk about this at the end of the webinar on some of the factors that are impacting real estate. But again, interest rates are one of the biggest factors affecting buying power for investment real estate. Cap rates appear to have topped and starting to then kind of come back down. Again, you want to buy at a high cap rate and then sell at a low cap rate. And we'll get into that a little bit more later. The price per unit is also starting to increase again overall when we look at multifamily units. And I have some data, I'll show you that. Okay, that's our exec summary. We're going to hop in now to the details on the national multifamily market. And again, a lot of this data comes from things that I compile over the quarter. I look at CoStar data, apartmentlist.com, a variety of different resources that I pull and give you charts on. So a lot of this is third party, and I just basically bring you all of this information and try to tell you a story. And I think the story on vacancy and rent and unit data will be told here now through some different charts and a variety of different things. But we like to start with the overall vacancy rate. What is the vacancy rate? And when we look at this data, this is actually 5 units or more. So we're not looking at single family homes, duplexes or fourplexes. We're looking at 5 units and more. So really true multifamily. And that vacancy rate really, when you look at the last few years, was 6.3% in January of 2023. A year later, it was 7.6. A year ago, it was only 8%, increasing to 8%. And then October of this year, the last time we did our webinar, was 8.2. Today, it's 8.5. It's making a new high here. But it is starting to peak. We've been seeing it peaking for a while. We thought it would remain the same, but it's up just slightly to 8.5%. This shows you a graph. And again, I want to talk to you about 2 different types of vacancy. One is the overall vacancy, and one is the stabilized vacancy. That overall vacancy is at about 8.5%. That's the number I was showing you. That includes properties that are in lease up. So newer properties that have been brought to market in a lease up. Whereas if you've owned a property for a long time and you're stabilized and you're just moving people in and out, you should be closer to 7% on your vacancy rate. So again, 2 different numbers. Want to make sure you understand the difference. Overall vacancy includes all properties and properties that have been delivered to the market recently and are still in lease up, whereas the stabilized vacancy takes out any properties in currently lease up. This is a chart, again, coming to you from CoStar that talks about how many units have been delivered in the past 12 months, over 500,000. And that number has been falling. So that's a green arrow. That means it's good. It's been falling because we're delivering less units, which is good for the market because we're now, we're as we bring in less units and we absorb those units, it's better. But that number was 7 or 8 or 900,000 here a year or two ago. So it's coming down and been coming down almost every quarter that we've been doing our webinars now. The amount of units that we absorb, which is about 434,000. So that number is less than how many have been delivered. So that's why that vacancy rate went up to 8.5%. So again, vacancy rate, we want the amount of units being absorbed to be more than the units delivered, and that will bring vacancy rates down. So absorption is the key. How many units are being rented of the new supply, of the supply being brought in, shows us where that vacancy rate is. And again, a vacancy at 8.5. And then we've got the rental growth rate. And over the last 12 months, it's an anemic 0.3%. So well under 1%. That's the nationwide growth average. Obviously, you're experiencing that depending on which market you're in. You're experiencing different numbers. But again, very, very low rent growth. And that's been falling really for about 3 years. This shows you the overall rent per square foot. So we take all units, all types, studios, ones, twos, threes, fours, you name it, and we look at what is the rent per square foot. And you can see from 2020 to where we are today, we've kind of in this range the last 2 years between $1.95 and $2 a square foot. So that's how much you're getting per month on your rental rates on average for multifamily units. And you can see that long-term trend line. We're actually below the trend line now. So really shot up dramatically in there in 2021, 2022 during COVID. Huge increase from $1.75 all the way up to $1.90. And we've been really kind of sideways to slightly up since. This shows you some data going back from 2014 and then really forecasting where we're going to be through 2030. And you can see here right now, this is about how many units we have that are vacant in the market. You can see the numbers kind of where we are. We're at 8.5%. We're projected into 2026 to drop down slightly to 8.4%, and then into 2027% under 8% and beyond. So that's kind of the projection. We're currently at $1,758 on average over all multifamily units per unit. And then that's about $1.96 a square foot. That is the market rent. The effective rent takes into account any concessions and things. And so that's really what the owner might achieve after concessions. So again, but you can see that, hey, as we are moving forward into the future, that rent per square foot is forecasted to go from $1.96 to $1.99 by the year end of 2026, all the way up by 2030 to $2.16 a foot. So again, overall, there's some good tailwinds behind us that's going to push that market rent up, and that'll be good for owners. That rent growth, though, is still less than 1% being projected for 2026, and then it should start growing at 2% and beyond there into 2027 through 2030. I brought this graph in. This is really some factors influencing the market, and I'll talk about this in the third section of this webinar. But I like to bring this up. This just shows you how many. The blue line is how many single-family permits have been issued, and then the green line is the multifamily permits that have been issued all the way back to the 60s. And you kind of tells you a big picture here of the amount of units being delivered. And it's just this comes to you from the Census Bureau, the Department of Housing via the Fred site, and great information here. This comes right from the Fed, and you can see that single family permits have really declined, and then that green line permits have really fallen off and stabilized down there around that 400,000 to 500,000 unit range, kind of where it has been historically. You can see where that gray bar back in 2008, 2009, up to 2010. That's the Great Recession. And you can see what really happened there with multifamily permits really dropping off a cliff. Same with single family permits really falling during that Great Recession. And where they were. And so you can see some big swings there based on big recessions. But again, right now, I don't see us heading into an area where we're overbuilding. We're just really absorbing a lot of the units that have already been delivered from 2021, 2022, and 2023. This again is from CoStar. This shows you how many units have been delivered by quarter. And you can really see that we hit a peak in the spring of 2024 where we were delivering a lot of units in the market every quarter, and 200,000 units. That's basically averaging 800,000 per year. It's a lot of units being delivered, and construction's been really falling off since late 2024 through 2025, and really projected to be, down there in the 50, 60, 70,000 units per quarter range of new units being delivered. This is another source of rental information that we have. This comes to us from the apartments list. This is another source that shows us where the average apartment of all bedrooms, the median rent is. And you can see that we've been really sideways since 2023 to almost slightly down. And so that average rent is now around $1,367. That's below the number of what CoStar is showing. Again, and this is all units, including duplexes, triplexes, and fourplexes. So again, a different survey shows us the same trend line, but a different number. Just wanted to bring this to you to kind of show you a little bit more of historically where we've been. The big picture here is that during 2021, during that COVID time, we saw rents really skyrocket. And you can see that, what happened from 2021 to 2023. And now we're really coming back down to really catching up with where, that market was, and trying to find some new ground and stability after all that new supply came to the market. This shows you the long-term trend line again on that, and we are now below that long-term trend line. And so again, that's a healthy thing for tenants. Ideally, we're going to find new ground, and then we'll see some new rent increases coming in the next couple of years for owners. This shows you the year-over-year growth. So kind of the same story in a different chart. It just shows you growth. And you can really see what happened again during that COVID time, where rent growth just grew at between 10 and even 15% per year. Just unsustainable growth for tenants. And really that fell off in late 2022 and into 2023. And it's actually been negative for almost well over 2 years now, almost 3 years. And we're at negative 1.1% rental growth rate. So again, really showing some numbers that are, obviously challenging for owners. And a lot of you are probably feeling this and seeing this today. This shows you by quarter. So again, there's a lot of seasonality to the rental cycle. We always say that spring lease up time is when rents start to grow, and you see new properties coming to the market and new leases put in place. And then that second half of the year, we always traditionally kind of fall off. And so, right now we're at a negative 1% blended for the year. We're probably somewhere right around even or just minus 0.5% per apartmentlist.com. But that just gives you an idea of the seasonality year by year of what's happened. In 2021 and even into 2022, we saw very little downtick in rental growth rates. So obviously 2021 was a crazy anomaly type of a year. This shows you the apartment list vacancy rate. They're tracking 7.2%, which tracks very closely to the 7% number that I showed you for CoStar. So again, pretty close for stabilized property vacancy rates. This is a very interesting graph that shows you the median time to get an apartment rented, or the marketing time. And you can see that we were down under 20 days to get a new unit rented in the US back in 2021. And that has been steadily increasing over the past 4 or 5 years. And right now we're at 36 days to get a unit rented, and it's still climbing. So we'll see if that makes a new high. But again, seasonally, we see kind of the latter part of the year and the beginning part of a new year where that tends to be a little bit higher. We're coming into the spring lease up time now, and so that number should start to fall. Hopefully, we find some stability with this number and that number starts to come back down. But this is just telling you the story that it's just taken longer to rent apartments when they're vacant. So vacancy is not your friend. I don't need to tell you this. We understand this at Landmark as well. And so keeping tenants in your units are really, really important. So focusing on occupancy is something that we're really seeing in 2026 and making sure that we're renewing those leases at fair market rents today and really trying to avoid any vacancy, undue vacancy. Okay, so some key stats on what we've just gone through in the national multifamily market. Again, Q2 of 2024 was really the top for multifamily construction. New permits and construction has really been slowing multiple quarters in a row. Absorption of new units is strong and increasing despite new inventory, but still a little bit below the new units coming on. So vacancy is still creeping up. We need absorption to really surpass the new units coming up for vacancy to drop. And then due to the supply and the time to lease is really at a 5-year high. And so we just saw that on that last chart. And rents are starting to increase just slightly. We saw that on the CoStar number of 0.3%. So again, mainly with new product is what I'm seeing. So that new product that's coming online is really bringing those rents up in some of the new product. But existing properties, again, are a little bit more challenged to rent at those almost the same rents that they were last year. Okay, we're going to talk about some sales on the national multifamily market, and we're going to give you some sales data. So, from CoStar, this is a great graph. The orange bars, those sales bars, show you the sales volume in billions. That's on the right column, 20 to 140 billion dollars per quarter. And you can see that we had a huge spike back in the last quarter of 2021, where we were almost $120 billion in multifamily sales. Low interest rates, a lot of money being pumped into the system, just an amazing record quarter that we have yet to surpass. And so you can see that we've really been falling ever since. 2023 was really the low for sales. 2024 increasing. 2025 is still strong, albeit, we're still, kind of treading water on where we're at from 2024 and 2023. So again, we're up slightly, but we're still got a ways to go to get back to kind of that 40 to 50 billion dollar per quarter average. Record sales volume. And again, that peak, the blue line shows you the price per unit in the US. And so when you saw those record sales, you can see that on the left column, we have the actual median sales price per unit. And so that shows you that, we really went from back in 2020 to 210,000 a unit. We jumped up all the way to 270,000 a unit. And just an incredible growth in price per unit or sales price per unit. And then that's fallen way back down into the high 220 range, really closer to 230,000. We're above that now. And really, we believe the low is in on volume, and we believe that really now you're going to start to see over the next few years prices increase. Hence why I'm calling the market time to buy. I think it's time to buy, and you got to pick and choose those properties. And I think we're going to see some price appreciation moving forward in the market. Okay, some key stats on the national multifamily market. Values peaked in the spring of 2022. Values have pulled back and appear to be stabilizing and now starting to increase and forecasted to increase in 2026 through 2030. The supply of new units is slowing, as we saw with that inventory. We're coming back down into some finding a bottom and some stability there. And that's healthy because that's going to allow us to catch up with absorbing those units and then be able to bring vacancy down so we can start to see some rent growth on the apartment market. With reduced new construction, mainly due to construction costs, we will continue to see values increase and then ultimately potentially set new highs in 2027, most likely 2028. It's time to buy. So again, we think that it's time to buy. We think that the bottom is in. We're starting to see it, and we're starting to move back up into a healthier range. And we're super excited to see what happens in 2026 and beyond. Okay, let's talk about capitalization rates. And a cap rate or a capitalization rate is really an indicator between net operating income, NOI, and the sales price, or maybe it's the asking price. And so we look at that, and when we look at sales of properties, and then we look at what their income is, we can derive what the cap rate is as a decimal, and then we convert that into a percentage, and voila, we get a percent or a cap rate. And so when we're comparing these things, it's just really good to kind of understand, where value is for income producing properties. So as we look at some of these sale data in the market, we'll be able to then understand what those rates of return are. It's really also your annual rate of return if you paid cash for the property is another way to look at a cap rate. So you kind of want to buy high and you want to sell low. We say, you want to buy at a high cap rate, that'll be a lower value, and a cap rate that's low is when you kind of want to sell because then that generates a higher value. So again, there's an inverse correlation. Um, I've got some tools and a few things for you. Here's an example of $100,000 of NOI at a 6% cap. So when we take 100 grand and we divide it by 0.06 or 6%, we get 1,666,000. And that's the value of $100,000 of NOI. If we needed a 7% cap rate, we could pay 1,428,000. So again, the value drops at the higher the value. And so take 100 grand out on your calculator, divide it by 0.06, divide it by 0.07. You should get these two numbers, and then you'll kind of understand a little bit about where value is. And so think of it also as if we had 1,666,000 and we wanted a 6% return, we would get $100,000 a year. If we had 1,428,000 and we wanted a 7% return, that would also generate us $100,000 a year in income. So again, just a correlation there. Like to explain that. I have a great calculator tool, CREcalculator.com, where you can go and put in your property value, all the specifics. I've got 7 steps here. It'll generate a PDF for you, an Excel spreadsheet. You can also see what your value is. Great tool for you. Hope that you can maybe use this and play around with it and just understand more about your value on your property and what it's worth. These are the current US cap rates. And so you can see back in the spring of 2022, we were at a low of almost 4.4% on the cap rate, really low. And then, where we are today is we're closer to between a 5.5 and a 6% cap rate, depending on whether the property is a 3 or a 4 or 5 star property or quality. Okay, so let's summarize the national multifamily market. Construction boomed and peaked in 2024. Rents are flat to slightly increasing with new product that's coming on. Vacancy rates are peaking, that 8.5% level, still peaking right about now. Sales are slightly increasing, stable, definitely increased over 2023, fairly similar to where we were in 2024, but slightly increasing. Loan to values really have dropped dramatically. We used to be 70 to 80% with 3 to 3.5% interest rates, and today we're really in that 55 to 60% loan to value range with rates, 6.5, even 7.5%. So depending on how long of a term that you need on your rate. Cap rates are starting to top out, very much interest rate driven. And the price per unit has been falling since the peak of 2002, that second quarter, and they're really bottoming it out and starting to move back up now. Okay, that is our national market update for the United States. Okay, we're going to now talk about the local Bellingham multifamily market. So let's hop right in. I've got here an executive summary for those of you that don't want to stay around for the full report. 2026 multifamily market update. This is looking back into 2025 and looking forward into 2026. New construction definitely has driven up vacancy rates to over 10-year highs. And we have seen that with all that supply that came online in 2021 and 2022. 2026 is really slowing down on new construction. We're not seeing as much coming online. Still a few properties, but definitely slowed from that boom that we saw a few years ago. It is harder to pencil deals with today's rates and costs. Rates are coming down a little bit. Costs are starting to come down. There's a little bit more breathing room in the market, and the COVID craze and all the money and all the things that were chasing deals has really slowed way down. And so I think we're starting to see some softening in prices. Some of the construction numbers I'm starting to see from developers are definitely coming in under what we saw a year or two ago. So we're definitely seeing some softening in the market. But again, it's still harder to pencil, but getting better. So I'm optimistic that through this year, we'll start to see rates come down and then also costs come down more. And hopefully deals will start to pencil better in 2026. Vacancy rates have peaked and they really fell a little bit from some of the previous quarters. We're still, right there at the highs, but again, vacancy rates are definitely peaking. And the overall rent per square foot is actually slightly increasing. It's flat to slightly increasing, depending, and a lot of it is really that new product that comes online kind of brings rents up a little bit. And then we had a big sales spike in the Q2 and Q4 of this year. There was a couple of big sales, and we'll talk about those. Cap rates are really leveling out. New regulations at the state and local level have really impacted a variety of different things, and Kim has gone through that at the local level here for Landmark, and she's talked a bit about that. And so again, we'll review that again with you here shortly. So let's talk about the Bellingham multifamily vacancy rate. What is it? And again, we've been back in January of 2023, we were at 2.4%. A year later, we popped up to 6.6, really the high. Actually, we went a little bit higher than that, but that was the high for this particular survey. And then we dropped down to 6.1. We dropped down again October this year to 5.8. kind of some data got resorted at the end of the year and we popped back up to 6.4%. Not a lot happened. It was just, I think, some new accounting that happened on CoStar's basis brought that rate up. I didn't see anything that dramatically added to that. So again, they recalibrated a few things and we're now at 6.4%, but we are projecting that that will start to decline. And you'll see that here. You'll see that we're really currently that overall vacancy rate peaked back in 2024 at over 8%. Have fallen way down here, and the stabilized vacancy is right around 6. And again, our market vacancy is right around 6.4% overall vacancy, which includes all properties in lease up. Stabilized vacancy again is properties with that are not in lease up. And you can see those two lines are actually starting to close in pretty close, meaning that we've basically absorbed a majority of the new properties coming in. We've got a couple coming online in later 2027 that could spike things up, vacancy up a little bit. But right now, we're really showing that we're going to start falling down from the 6% level over the next couple of years. Units delivered in the last 12 months, 135 units. We've absorbed 266. Again, that pushed the vacancy rate up. It should push it down based on the last quarter, but there was some recalibrating a couple of months ago that I saw with CoStar data. So the number did pop up at the end of the year and then actually technically fell down a little bit at the end. But right now we're at about 6.4% based on the way they're calculating numbers. What happens is sometimes they don't catch properties that are in lease up and then they bring them into the system and then they get added in. So I've seen that they've missed a few things in their data on the local Bellingham market. So those properties got added in and pushed the numbers up a little bit higher. Asking rent growth is at 1% and actually falling, but we're still above the nationwide average, which is only 0.3%. This is some key indicators in the market, and you can just kind of see where we're at between 1 and 2 star properties at 7.5% vacancy, and 4 and 5 star at 5.5. So the higher the quality of the property, the lower the vacancy rate. And you can see where those rents are at. Actually, their highest rents at $18.50, lowest vacancy rate as well. So again, depending on the quality, you'll see different vacancy rates there. This is another graph that I love to show that shows the U.S. vacancy rate in yellow. That's the yellow line. So we're the green line in Bellingham, Whatcom County, and our rate is below the nationwide average. And then you can see these blue and orange bars. The orange bars are how many units we're absorbing. How many units are renting up and filling those vacancies or those new units that are coming online? And then the net deliveries are the new properties coming online. And so we have one big project out in Ferndale that's scheduled now for the second quarter of 2027. And it's 350 units. And that can add a huge amount of supply into the market. There's a couple of other properties that are also going to get delivered later this year that are not on these marks. And I've mentioned that before. And so the numbers will get skewed and adjusted when CoStar catches up with that data. But for now, this gives you a pretty good indication of where things are happening, what's being built, and what's being absorbed. When you look back into 2021 and 2022, 2023, and 24, you see a lot of properties that were delivered. Those blue bars were really high, a lot of units coming online. And that is why our vacancy is really at 10+ year highs. This is the average rent per square foot in the market in Bellingham. So cutting through all 1, 2 bedroom, 3 bedroom, 4 bedroom studios, all unit types. You can see here that we've got an average rent now running between $2.20 and $2.25 per square foot. We're actually down just a little bit from the previous year, the previous highs. But again, that is typically seasonal. And then we see that rate start to come back up later in the year. So I do expect that to kind of bounce and then come back up and then ultimately make a new high in 2026. But we're right now slightly below the trend line, the 5-year trend line. This is some data that comes from Reventure app. I'm a subscriber to this and I've just loved this data. Just some great information. This is the overall rental rate of Reventure, which is mostly apartments. They don't capture all of the rental information like CoStar does of multifamily units, but they capture a variety and they have some different resources that they pull from. A lot of other third-party services like Zillow and Redfin and others. And so you can just kind of see this story from 2005, where the average rental unit was 840 to today, we're over $2,000 a unit. Then this is all units. The next graph is actually with houses, and I'm going to move my screen out of here a little bit so you can see, but you can see that we went from 1,050 in single family homes in 2005 to over 2,500 for single family homes. That's SFR, single family home rental rate. So again, big change in that, and just another great data for the local Bellingham market. As we look at single family homes cap rates, and again, this is the cap rate, that rate of return if you paid cash for a house, and you can kind of see where we're at. And right now, again, and cap rates for houses are always a lot lower than multifamily buildings, but it's just a great indicator of where the market is underlying for single family homes. And I just thought this was really interesting. You can kind of see when the market was really crazy, we were down at the 2.8 cap rate range. And then when we hit that Great Recession, we moved up to over 4. Today, we're kind of in the middle, right around 3.4, and that seems to be a good 50-yard line, if you will, for where cap rates should be. And again, what I have seen is, yeah, below 3, pretty aggressive, above 4, kind of a buying opportunity for single-family homes and cap rates. This is the single family vacancy rate. This also comes from Reventure. This also counts homes that are for sale, and so they count them as vacant, a lot of them. And this number seems a lot higher than what I would anticipate. We're not seeing this at Landmark. We're seeing vacancy rates much lower for single family homes, but this is the data they got, and the way they pull it actually does count some for sale properties and counts them as vacant. So the numbers are a little skewed, but it's consistently skewed. So you can kind of see where they're at. And right now they're fairly low. It's relatively low right now at 8.65, and that's historically really over the past 20 years. That's about an all-time low from where we were back in 2017. So again, and that kind of coincides with what we're seeing in the market, that there's a lot of demand for homes and rentals, and that has always performed a lot better than multifamily from a vacancy rate standpoint. But these numbers, I don't give a lot of weight to these actual numbers on the actual vacancy, more just the indication of where the graph is. Okay, let's now hop into more of the sale data. And this is now sales in the past 12 months. We've had 11 sales in the last 12 months, $13 million with an average vacancy at the time of sale of about 7.7%. And you can see that we had one big sale there of $50 million. And that was one that happened back in the happened in the second quarter of the year. There was also another large sale that happened to Barclay Trails and Barclay Park, happened for just under $48 million, and that sold in October. We actually had a couple of big sales in October, almost 60 million in sales. And that is by far a really big record for Bellingham and Whatcom County. And you'll see that on the graph on the next page. But very uncommon to see a couple of $50 million sales in our market. Exciting to see that activity and investors coming in. And so again, couple of big sales that really skewed the numbers, and kind of exciting stuff. And here's that graph. The orange show the sales bars. And so when you look back in 2021 and 22, those typically were the record years. And we've been really quiet since. And then all of a sudden, in that third and fourth quarter of this year, you saw big sales, 50, $60 million in sales in multifamily. And really the fourth quarter this year set an all-time high, mainly because of a couple of really large sales. So exciting stuff. Neat to see that happening. You also see the blue and the green lines, which show you the actual price per unit. And that's really what you probably want to focus in on. And you can see that we made a low of about $210,000 back in late 2023 and early 2024. And now we're moving back up over the 225 mark and beyond. And you can see Bellingham is actually slightly below the US average, which kind of surprises me a bit. But that is that we are price per unit is slightly below the US average. Again, I think it's a good buying opportunity. And CoStar is showing that that price per unit is going to continue to move up and eventually by late 2027, 2028, surpass the all-time high price per unit. Another reason why I'm saying the time to buy is now. These are cap rates, and we discussed cap rates earlier in the webinar. This shows you where the cap rates are in Bellingham and Whatcom County. And again, you can kind of see the US cap rates, which are higher than those local Bellingham cap rates. And again, higher cap rate in the 6 range. We tend to be in the 5.5, 5.6 range, depending on the quality of the property. I've seen some trade at 6 caps. I've seen some trade at 5 caps. So 5.5 is about the 50-yard line right now for Bellingham. Albeit a lot of smaller properties that have sold have driven that cap rate range down. We had a low back in late 2021, early 2022 of mid 4s cap rate. So I don't know if we're going to see those again, but CoStar is showing us to come back down into the low 5 cap rate range by 2028 and 2029.
Hello, welcome back. We're going to talk a little bit about some landmark data. So this is our internal portfolio of properties that we manage, primarily in Whatcom County on the residential side. So we'll start off with what is Landmark's current vacancy rate? So Troy's just spoke about what the national vacancy rates are at. So internally with our residential portfolio for as of today, we are at 3.6%. So this includes our properties that are in lease up under new construction, so have never had tenants before. So this number tends to be higher than obviously the properties that we exclude from our lease up. But 3.6, so the green arrow indicates that we are down. So last quarter we were at 3.8%. So we're trending in a good direction there. So then our next slide will look at that exclude the new construction lease up, and our vacancy rate is at 2.9%. Also down from last quarter where we were at 3.2%. So that is great news. Now, if we look at the Q4 average vacancy, we were at a 4.1, and that is up from the previous quarter in 2025, which was 3.87. That is typical for that time of the year. Q4 is typically a time where people are not moving in Whatcom County. The weather tends to be a little colder, darker, damper. We got a lot of holidays, so we just don't see as many people vacating, ending leases. Majority of leases do tend to end in the summertime months. So just want to point that out. And then we will move into some more landmark data. So just a couple fun stats here because we're at the end of the year. We had, as a company, 296 4- and 5-star Google reviews. And those are organic reviews that our team is sometimes asking when we meet with a client or a tenant, but those are all positive reviews. So that's super exciting. We're really proud of those and our team that works hard. We also processed 5,902 rental applications. So a staggering number of new tenants that are coming into the portfolio. We're processing, we're screening, we're ensuring that those tenants are qualified and are going to be great tenants to live in your properties. Okay, moving on. So this is for our portfolio, the price per square foot that we're getting on average by studio 1, 2, 3, 4, and 5 beds. So you can see our studios on average are renting at $2.88 a square foot. Just to kind of put it in perspective, you can see it kind of drops slightly. Our 3 beds are renting at $1.75. So 3 beds are getting the lowest price per square foot. And then the 5 beds jump back up to $1.91 a square foot. The next slide sometimes is a little bit easier to comprehend, but you're looking at the average rent per bedroom size. So often when we have roommates, we have a lot of college students, they're looking at the cost per bed. So our studios on average are $13.42 a month, 1 bed's $14.64 a month, 2 beds $17.88 per month, 3 beds $23.12 a month, and 4 beds are $29.73. So again, average rents by bed size today. These numbers we track these on a quarterly basis. These have trickled up by a couple dollars each. So that's great to see, even with our higher than normal vacancy rates. We still are seeing slight increases in rent prices. I also have data on all of that up to 7, 8, 9 bedrooms if anybody's interested. Okay, so I just wanted to touch base on City of Ferndale Initiative 2501. So that did unfortunately pass by quite a landslide. So basically what this measure limits the amount of application fees, late fees, lease violation fees, admin fees entirely. It caps our application fees at lower than the cost to actually process the application. So that's, us doing our due diligence to be able to process background checks, credit checks, income verification. There are state laws that already limit those fees to actual costs. So it was kind of disappointing to have more regulation impact us in our community. In some cases, they're limiting late fees to amount less than the actual cost of postage required to issue required legal notices to address late rent. So we just feel that it's going to have a negative impact on housing assistant vouchers, current tenant, current landlords. It's possibly going to discourage development of new housing. So we are, as a company, prepared to handle this new regulation. So we've had to update our lease agreements and change the way that we handle lease violations, late fees, and application fees. But again, it was very similar to the ordinance that passed in the city of Bellingham. So luckily we were prepared and ready for that. Another City of Bellingham initiative that did recently pass was 2503. This was basically an attempt by activist organizations to circumvent normal standards in legal proceedings and make it easier to file frivolous lawsuits against landlords. So it basically allows activists to come in and kind of unionize tenants and hold meetings in common areas and gives them a lot of the same rights as tenants, even though they don't live there. There's a lot of posters that will need to be posted once the city comes out with that language and verbiage, updates to the lease agreement. We are just mostly concerned about a lot of the hidden text in it. There's already a lot of state and federal laws that protect tenants from freedom of speech, but we're concerned that this measure is going far beyond that. So we're working with our legal team to make sure that we're set up for success here and that you and your buildings are protected. So that is it on legislation. There is obviously a lot of legislation that will happen in the first quarter of 2026 that we will stay on top of and keep you informed of. There's some new state laws that impact the way lease renewals are handled, and those have been pretty arduous as far as sending out copies to every single tenant for lease renewals, sending those certified mail, personally delivering. So we have heard from our um, legal sources that hopefully the requirements for that will be changing. So we're just really going to make sure that we push and provide data and are a voice for change and some of those things. So more to come. I just want to remind everybody, if you are not currently a client or you are a current client and you're looking at purchasing new property, feel free to reach out to me. My email and direct line are below. And we'd be happy to give you a free market analysis on your property and just let you know what we think it can rent for, give you some tips and tricks. So anyways, thank you so much.
That's awesome, Kim. A lot happening. End of the year, beginning of a new year. The new rental cycle is right around the corner, if not here already. Come February, you're already into pre-leasing. So a lot happening. Trying to be proactive and optimize people's properties. So
Yeah.
appreciate all the work that you do, and if you need anything, feel free to reach out to Kim. She's got a huge team available to help you with understanding any of the new laws, the changing laws, and then obviously if you're looking for a new property, or you're not a current client and you want to understand more about what the rent should be on a property, we're happy to give you a free market analysis. So, Kim, thank you again for all that
Yeah.
you do. So
Thanks.
appreciate you, and we'll head now into our next section. Okay, a lot of information. I'm going to now talk about the factors impacting the market, the real estate market looking forward. And so, a lot of information here that I want to go through. Number one major factor is clearly interest rates. Here is the 10-year Treasury chart. I show this every quarter, and you can see that the Treasury rate is still below 5%. It's actually closer to about 4.1, 4.2% right now, and we're predicting that that's going to break 4%. More to come as the Fed continues to soften interest rates and come down into the high threes, the mid threes, is what we're anticipating to see. And you can see that by the market expectation of what the Fed funds rate is going to do. Technically a little bit different than the 10-year Treasury, but they track very, very closely. And you can see that people are anticipating that, from 3.6, 360 today, really dropping down to really 3% by the end of the year of this year. So that'll be really interesting. That could be a 3.25, 3.5% Treasury rate. Your interest rate is anywhere from 175 to 2.25, 200 basis points over that. So you could see interest rates in the low to mid 5% range by year end if this comes true and if this chart does play out. Here is investors' expectations of where rates are going to go. This comes to us by Marcus and Millichap, very similar to the last graph, but it actually shows you where we've been in the past. And so you can see kind of how low those interest rates were, basically down to zero, 0.25% for almost 2 years, which spurred low interest rates and all of that spending and building. And then we started moving up in 2022, and then really gapped, didn't do anything late 23 through 2024. And then we started softening. And here we are coming back down the stairwell. And the question is, where are we going to land? Where are we going to head? And how far into the threes will we go, and will the Fed go? So again, and you can see the Fed funds rate as it's compared to the 10-year Treasury. Again, they track very similarly, but the 10-year Treasury are bonds trading, 23 hours a day. They trade nonstop, and the Fed funds is what the Fed sets the rate at. So when you hear the Fed changing interest rates 0.25%, they don't always come down directly. You can see that Fed funds rate for all of 24 was at a higher amount. And then when the rate came down 0.75 points, the rates, the blue line didn't change much. It actually stayed the same. It kind of got volatile a little bit. So again, the market, the treasury bonds predicts where they take into account where they believe the Fed's going to go. So a lot of times we say that the Fed funds or the Fed decisions are built into the treasury rate, and that is very much true, and you can see that on this graph. This is another great example of where mortgage rates have been and where they're kind of going. And so you can see the blue line. This comes to us again from Reventure, kind of one of my favorite apps right now. And they shows you where interest rates were in 2023. The blue line. These are sub 3% mortgages, and you can see, through 2023 all the way up into 2020, not a lot, less than 5% of the market had a rate under 3%. And then rates went down, which means the amount of people with sub 3% mortgage shot through the roof. Over 24% of the population has a mortgage now above 3% come 2022, 2023. And now that's starting to fall down. Conversely, you look at the amount of people with higher interest rates, and that number has been consistently falling. But then everything stopped in late 2022 and those rates started to go back up. So the two are now going to cross. We're basically at 20% of the population below 3% and 20% above 6%. And so they're getting ready to touch and probably cross. So healthy sign, because we like interest rates to come back down and more people will have those lower rates. So that's the goal, hopefully. But, again, soon to be found what will happen. But this is the impact of higher interest rates and where they're coming. Let's talk about shelter inflation a bit. This is the U.S. asking rents. I showed this chart to you earlier in our national update, and you can see that blue line is basically U.S. apartment rents and that year-over-year change. And you can see during COVID, 2021, that thing went way up and way back down. Then you look at the red line, which is shelter CPI. That is the portion of real estate CPI, the real estate portion of the consumer price index in it. And you can see how that was impacted. And you can see the delay of CPI after those rents shot up. It took a while for that to work into the system and then hit CPI. And now, so it's definitely a lagging indicator, CPI, to where rents are. And now that rents are actually below 1%, they're growing negatively per the apartment list chart. You can see that we're still working our way down. So CPI is still softening. That's a good thing. Housing costs coming down is in general a good thing for the consumer. As landlords, we want to see some rents. We want to see some appreciation of those rents. So more to come on that. Let's talk about renter demographics. This comes to us from Marcus and Millichap, and I thought this was really fascinating, where you look at, who is shaping the multifamily needs of the future. And that millennial generation is 74 million people, and they are, you can see the age of where they're at. And they're a huge part of what's driving the apartment demand. And so it's just really, really fascinating. And as they start to work out and work into their first time home purchase, they're going to leave apartments. And so we got to look for that younger generation to come in. And there's plenty of them as well, too. But the millennials are really driving the apartment market today and their needs. And so, again, just fascinating graph. We could talk a lot about this and the implications of this. But again, there doesn't seem to be a gap coming behind them, a small gap, but not a huge gap. There's still a steady amount of people that are younger that will be coming into the market and then also renting apartments. But this has also played into a little bit of the vacancy as some of those millennials move out and into home purchases. Cap rates versus interest rates. Okay, I love this graph. I try to show it to you every year. This also comes to us from Marcus and Millichap. And you'll see that average apartment cap rate right around 6% in the US versus the 10-year treasury rate. And right now that treasury rate's a little bit lower than 4.3. It's about 4.1. And cap rates maybe right around 6% still. And the gap or the difference between the two is really your spread as an investor. And so you look at that. Now, your treasury rate plus an index equals your actual mortgage rate. So, but you want this spread to be pretty thick, and that's a great time to buy. When it's narrow, it's not the best time to buy. And so you can see some of these arrows back in '05 when the market was tightening and they were coming close together. There was a lot of people buying, and then the market churned. And then when the spreads got really, really big, I mean, almost 500 basis points, not a lot of people were buying. It was an amazing time to buy. So for those that did buy right after the crash and had the cash, they did really, really well. You can see in 2020, there was a really unique blip where we got to about 420 basis point spread between the two. And that's when interest rates went way down really low and cap rates were still elevated. And it was an amazing time to buy. And then as interest rates went up, the faucet shut down. But the spread, you want these two lines as far apart as possible when you're buying, and you want them as narrow as possible when you're selling. Here is another trend to show you the downtrend of the cap rate trends between the apartment cap rates and the 10-year treasury. And you can kind of see this downtrend from the 90s to where we're at. We're kind of popping above it right now with higher interest rates and a little higher cap rates. So more to come on kind of where we're at. Will this fall back down into the range? 2026 and 2027 will tell the truth on whether that happens. This is the changes in transaction velocity and how that's linked to cap rates. Basically, the more sales that occur, the cap rates fall and they come down and they get low. So you can see that blue line is apartment transactions. And in 2021, 2022, when sale activity shot through the roof, all-time high sale activity nationwide, which we saw earlier, you can see cap rates fell to an all-time low. Volume equals cap rate, where the cap rates go. The less volume, the higher cap rate. The more volume, the lower cap rate. Okay, let's talk about local inventory now. In the Bellingham market, you're going to see this is from the City of Bellingham Permit Center as of January 7th. We pulled this info, and you can see that there are about 194 units finaled. Only 59 of those are multifamily units, and that's down slightly from 183 the last quarter. You can see that the units under construction are actually up a little bit from where we were last quarter at 792. They're at 955. Granted, 627 of those are multifamily units. And again, you can see the projects and where those are at and what stage of the permit process. CoStar is not picking up a lot of these units, and that's what concerns me with the vacancy rate and kind of where it's at. And so again, we're monitoring this and we're trying to keep track of these projects so we know what's going to get delivered, will it get delivered, and how will it get delivered. We have 255 in application, and that's down from 343 units. Again, 177 those are multifamily, and 78 of those are single family. Let's talk about the single family sales market, which also drives the apartment market. And you can see here, I've got two main charts, the median sales prices and inventory. They tell the big story. And so let me move my screen, my camera down here a little bit so we can see things better. And I will now show you, this is the median sales price for Bellingham, Seattle, and Whatcom County. And this is shown on a trailing 12 months. And you can kind of see where those numbers were. You can see where they were back in October of 2007, 315,000, 459, and 290. And then today, Bellingham's at 755. That's the green bar in the middle. The red bar, Seattle, is approaching a million, and then Whatcom County is at 625. Whatcom and Bellingham are actually down year over year. When you look at the last 12 months to the previous 12 months, they're actually down slightly. So kind of interesting, whereas Seattle is actually up almost 5%. This is the same graph, but every line is a month. So when we look monthly, again, same prices more or less, but you can see a little bit different. You see the volatility and the seasonality that happens based on the yearly season and sale season. So again, same story, just a little bit more volatility. I'm not really seeing anything here that changes. Seattle is still up, whereas Whatcom is essentially flat and Bellingham is down almost 4%. This is just closed sales, and I just showed Bellingham and Whatcom County in this graph, and you can see the purple line is Whatcom County closed sales, and this is by month, and then you can see Bellingham and kind of where we're at. And again, sale activity is definitely down from where we were in 2015 to 2018. It's been kind of in a downtrend in both markets, mainly because of interest rates. It's telling the big story. This is homes for sale and really interesting data here. Again, seasonally, you see dips typically happen in the fall, winter, and then the first of the year. So we're in a dip right now. But again, when we look at where inventory is year over year, December over December, all three markets are up significantly in their inventory. Bellingham's up 15% year over year, Whatcom 12%, Seattle up almost 25%. So again, that's telling another story. We've still got a ways to go to get back to all that inventory back in the Great Recession. And I get this question a lot. Man, is the inventory building like the Great Recession? Is it the same thing? If we have a correction in the market, it's not because of inventory. Inventory is coming back into healthier ranges, but we're still a long ways away from where we were. Bellingham, over 1,000 homes for sale. Today, 278. Whatcom County was in the 3 to 4,000 homes for sale. Today, under 1,000. So again, telling a big story there. Inventory is not telling today the same story that it told during the Great Recession. Okay, let's talk about nationwide home sales. And this is, again, coming to us from the National Association of Realtors. And you can see all that activity that happened in 2001 and 2002. People are buying homes at record rates, really six to 6.5 million sales a year we were averaging, and now we're down to about 4 million sales a year. We're tracking somewhere in that range. And so we're way below where we were during normal times. Right around 5 to 5.5 million is kind of what we're looking for. You can see during COVID, we fell down to nothing and then shot up. And then here we are today in the 4 to 4.2, 4.3 million homes per year being sold. This is showing every month. Every bar is essentially a month, but we're kind of tracking that annually. So as we look at the trailing 12 months, that's what we're getting is right around the 4 million range. So we're still a million and a half shy of where we should be in single family home sales. Interest rates, that's why. Let's talk about homes for sale, nationwide homes for sale. And this is also coming from Reventure. This is showing you another graph of all the homes for sale starting back in 2017, million two, million three, down to the peak of the market, which in 2021, we only had 500,000 homes for sale, really a low number. And so now we're back up to kind of right above that trend line of right around, just about 950,000 homes a year. We're above that, almost 1.1 million homes for sale today. So inventory is building nationwide. And there are some markets like Texas and Florida that have a lot of homes on the market. But again, depending on your area, this is what we're seeing as inventory building. We're clearly seeing this in our local market in Bellingham and Whatcom County. But again, it's not necessarily as bad as some other markets that I'm seeing. Okay, let's talk about housing starts. I showed this to you earlier in the nationwide update, and I just want to show it again. The blue line is single family permits issued, and you can see really the swings from the Great Recession where had a lot of permit. We were building tons of product, and we paid for it. And the market crashed dramatically. We really and we had a lot of building going on, a lot of permits in the single family market, but nowhere as close to where we were during the Great Recession at the peak. So COVID, we built a lot of product. That's now coming back down. We're coming into normal levels. When you look at the green line down below, that's multifamily permits, 5 units and up. And again, kind of a big boom there that happened during post-COVID, 2021, 2022. We've come back down to normal ranges of where homes are, 400, 450,000 home multifamily units being built a year. This is some reventure app predictions. This is showing you the whole US market, what they're seeing. They're saying the home price forecast is really forecasted for the next 12 months to basically be flat, be up 0.1%. And it's really, you can see this graph, whether you're above or below this line, this 50 line, it's either a buyer's market or a seller's market. And today, in the single family home market, it's a buyer's market. And when we look at Whatcom County, it's basically the same story. And we're definitely showing a buyer's market. And Reventure is predicting homes to decrease 2.3% in our local market. So again, bit of a somber news for those of you holding a home, but we're seeing a softening in the home prices. But in the multifamily market, we're starting to see values move up. So a little bit of a divergence there in those two different types of assets. Single family homes losing a little value, not rents, but losing values when we look at resales and such. So predicting to go down a bit. So buyer's market nationwide and locally and in most markets. Okay, home affordability versus rental rates. I love this. It just shows you that it's still very expensive to own a home. That average mortgage cost is well over $2,700 versus the rents just over $2,000 a month. It's actually cheaper to rent than own. And you can see times when that was different back, in the early 2006, 8, 10 mark, where interest rates were low, buying power was great, and you can see that it was actually more affordable to own, cheaper to own than to rent. But today, it's way out of whack, and so that's a good thing for owning multifamily rental properties. And so again, just wanted to bring this to you. I've showed this to you guys a couple of times. Okay, let's talk about some summaries and conclusions here. Bellingham and Whatcom County vacancy rates remain lower than the national average, albeit they're still a little elevated than normal. New construction locally pushed vacancies rates back into normal rates, even slightly above normal. So again, that's a healthy market cycle. I don't foresee anything really pushing those vacancies up, rates up too dramatically above where they're at today. Vacancy rates are starting to decline. They're peaking and predicted to start to decline. Higher interest rates have kept homeowners in their homes longer. Housing payment to rent, as you just saw in that last chart, gap is high. It's at an all-time high. Cheaper to rent than own, albeit rents are still moved up dramatically in the last 5 years. Long-term real estate outlook continues to be positive for Whatcom County, specifically in the multifamily market. We're seeing that in the CoStar data. We're seeing that with positive appreciation, slight appreciation in rental rates. And I think the price per unit is going to start to move up as cap rates start to come down and interest rates soften. And multifamily sales are really flat but we're seeing a lot of pent-up demand, and we saw a couple of really large sales locally, so booming locally, but kind of nationwide a bit flat. But it's exciting to see a couple of large sales here locally, and so hopefully that brings more and more investment. And when we see more velocity of sales, as I showed you earlier, that just creates more activity and more sales volume, and that's just healthier for everyone. Well, thank you so much for being a part of our end of the year 2025 and 2026 forecast market. On behalf of Kim Heisinger, our Director of Operations, and myself, Troy Moliot, CEO and owner of Landmark, thank you for being a client. Thank you for watching our webinar. And if you have any questions, feel free to reach out to either Kim and I, and the contact info will be in this link. Thank you so much, and we just wish you a wonderful and prosperous 2026.